What if everything you were taught about economic collapse was backwards? What if recessions weren't unpredictable storms, but carefully guided outcomes? And what if, hidden behind the noise of markets crashing and families struggling, a small financial class quietly grew more powerful every single time the world broke? This is the story of how the world's financial overlords learned to profit from collapse, not by accident, but by design. By the end, you will understand why the global economy keeps repeating the same destructive cycle, and why ordinary people always pay the highest price. To understand today's system, you have to go back to the moment money itself changed. Not when coins turned to paper, or paper became digital, but when debt became the world's primary product. This shift took centuries. It involved secret central bank formations, governments desperate for war funding, and financiers who realized lending to nations was far more profitable than lending to people. Names like the Medici, the Rothschilds, and J.P. Morgan didn't just participate in history. They steered it through credit and bailouts. The system they helped build wasn't a marketplace. It was a machine designed to grow fastest when societies struggle most. In this new world, financial collapses aren't just emergencies. They are opportunities. Moments where assets become cheap, governments become desperate, and the public is too distracted to notice the major shifts happening behind closed doors. The early 1700s saw the first big experiment, the creation of the Bank of England. It gave a private institution the power to issue national debt on a massive scale. The lesson was simple. If a country runs out of money, someone can always create more, as long as you're willing to owe them. Debt became a product, and financial institutions became indispensable. But the real turning point was in 1913. Behind closed doors on Jekyll Island, the United States established the Federal Reserve, a central banking system owned by private banks with authority over the nation's money supply. What followed was a chain reaction. The 1929 crash, the 1930s banking consolidation, and the rise of the dollar after World War II. Every crisis reshaped the system, and every collapse tightened its control. The most important lesson was learned quietly. When economies fall, central banks gain more authority. After World War II, a new financial order was born. The Bretton Woods system. It tied global currencies to the US dollar and the dollar to gold. But by 1971, that gold backing was gone. Money became purely symbolic, limited only by political promises. This was the ultimate shift. If money is infinite, debt can be infinite too. From that moment on, financial institutions had the perfect landscape. They could expand credit, inflate asset prices, and buy out collapsed companies. They soon discovered the most profitable cycle in modern history. Boom, inflate, burst, buy cheap, and repeat. Every recession became a reset button that transferred wealth upward at breathtaking speed. The 1987 crash, the 1997 Asian financial crisis, the 2000 dot-com bubble, and the 2008 global meltdown. Each time, ordinary people lost homes and savings, while major banks and hedge funds emerged bigger than before. Was this just bad luck? Or was it built into the structure itself? 2008 exposed the truth more clearly than ever. Banks had gambled trillions and collapsed under their own risk. Yet, instead of disappearing, they were rescued with taxpayer money, emergency central bank loans, and near-zero interest rates. The collapse wiped out $19 trillion in household wealth, but the top financial institutions received a safety net bigger than any bailout in history. And the aftermath was even more revealing. Bank mergers created institutions too big to fail. Private equity firms bought foreclosed homes at bulk discounts, and central banks pumped liquidity into markets, inflating assets. The crisis strengthened the exact institutions that caused it. Collapse had become profitable. For the next decade, the world entered a strange new normal: record stock valuations, corporate debt, and housing prices. Meanwhile, wages stagnated and savings evaporated. When 2020 arrived, the response to global disruption was more quantitative easing and stimulus than the previous decade combined. But a 2021 study revealed that over 80% of this new money went directly into financial markets, boosting asset prices the average family couldn't afford. Again, the silent financial class grew even stronger during a global emergency. Governments attempted reform, stricter banking rules, stress tests, anti-monopoly proposals, but none addressed the core problem: a financial system where power increases every time the economy weakens. The machine isn't designed to prevent crises, but to survive and profit from them. Look around today. Global debt is over $315 trillion. Housing prices are at record highs. Inflation has outpaced wages. These aren't random patterns. They are repeating signals of a system optimized for cyclical collapse. To the public, it looks like chaos. To the silent players, it is predictable. So, here are 3 key takeaways. First, modern economies are built on debt, not productivity. Those who control debt creation control nations. Second, financial crises consistently transfer wealth upward. History shows that every collapse enriches the institutions closest to money creation. And third, collapse is not the end of the system, it is part of the system. This is why reforms fail. And third, collapse is not the end of the system, it is part of the system. This is why reform. The question isn't when the next collapse happens. It's who will own everything when it's over. If you want more deep dives into the hidden mechanics of modern finance, make sure to like this video, subscribe,